So I'm just going to talk about at fairly high level the various U.S. tax rules that came into effect late last year. Maybe we should start by a show of hands. How many of you have heard about the Trump tax reform? Okay, good, quite a bit, good. So the Trump tax reform was actually the biggest tax bill in about 30 years in the US. And it was passed into law on December the 22nd of last year. And it basically changes everything from corporate tax, personal tax, partnership tax, international tax, you name it, it changed it, okay? And some areas, the changes are huge. So, you know, for starters, the old US tax rate averages about 35% in the past for a corporation. And that's on the high side when you look at the OECD country tax rates. And because there's a corporate tax on each corporation, there's a DRD, a reduction in dividend that is going to be paid between corps. And under the new law, they cut that rate to a flat 21%. So that's a 14% drop, and that's a huge drop. And it's not graduated, meaning that there's no brackets of taxes anymore. It's all just flat rate. And because of the reduction in the tax rate, the DRD got grind down because you start off with a lower tax rate already, so they're not going to give you the same kind of deduction. And they also did away with the AMT, which is a tax that a corporation pay if it's got a lot of tax adjustments. So that was killed as well. So with all those, there was a survey or a study that basically says the average US federal and state tax is now about 25.8% versus our Canadian federal and provincial combined rate averaging 26.5%. So the US went from the high side on the OECD scale to one of the lower ones. The other thing that was extremely business friendly was this bonus depreciation rule. So the old rule basically says if you buy a capital asset, you can write off 50% of that cost right away. But it's only on new property. So it has to be a new property to the business that buys it. The new rules basically says you can write off 100% of the cost of that asset, as long as that is a tangible asset with a life of 20 years or less. So that covers virtually 90% of the assets. And they went one step further to say that this rule applies not only to new property, but to used property as well. So people got clever. How about I have a parent that has a used asset and I sell that to my sub? Then my sub can write it off 100% right away, right? Because it's used property and it's an asset that has a 20-year life or less. But unfortunately, the Treasury was clever and there was a related party carve-out that says, no, you can't do that. But imagine what this does, right? Instead of taking CCA from like our Canadian concept, you can actually write off 100% of the cost of your capital asset. So that's all so good so far, right? Because you have this big grinding tax rate and you get this huge deduction for the capital spend that you have for the year. So there's always give and take. One of the takes is that under the old rules, when a company is highly leveraged, there's going to be a limit on how much interest you can deduct. That's basically up to 50% of your taxable income if you're highly leveraged, meaning that your debt to equity ratio is higher than 1.5 to 1. Under the new rules, they lowered that threshold to 30%, meaning that your interest deduction cannot exceed generally 30% of your taxable income versus 50. And the policy point that they stress is that they don't want companies playing games by borrowing and trying to reduce their taxable income. But the good thing is that there's a carve-out for small businesses with average revenue of $25 million or less for the last 3 years. If you're in that category, this new rule doesn't apply to you, meaning that there is virtually no limit on the interest deduction. The next part of the tax reform is very interesting. So there was a case at the tax court level that came out in July of last year that basically went against the IRS practice in this area for about 26 years. The IRS Rev ruling came out in 91. This case came out in last year. So for 26 years, the IRS practice, when you have a foreign person who has sold a partnership interest, is that they look at the sale of the partnership interest and they look through to see what the partnership did. Meaning that if the partnership had U.S. trade or business, that sale of the partnership interest is potentially U.S. source and therefore subject to U.S. tax. But this case, and by the way, Trump is also a verb, so that's not a typo, okay? So this case basically says, no. When a foreign person sells a partnership interest, that should be foreign sourced, even if that partnership had a U.S. trade or business. So they're going to treat that as a foreign source income, basically not subject to U.S. tax. That's what the court said, okay? But the tax reform says, no. We agree with what the Treasury and what the IRS thought, so we're going to make this a code section that says when a foreign person sells a partnership interest and that partnership had U.S. trade or business, we're going to treat that as a deemed sale of all the assets in the partnership, not a sale of the partnership interest. And they went one step further to say when you have something like that, there's going to be a 10% withholding tax on the proceed. So this is extremely taxpayer unfriendly. Next thing also in the corporate world is they changed the rules on the net operating loss usage. In the past, say you had $1 million of losses in year 1, and you had $1 million income in year 2, you can use the old loss against the new income, right? That's the old rules. And they give you a 2-year carry back and a 20-year carry over, meaning that your loss is good for 20 years down the road. Under the new rules and for losses that happen after 12/31/2017, your losses can only offset against 80% of the taxable income in the future. So you always pay a little bit of tax, even if you have losses from the past. But one thing that's progressive is they did away with the 20-year carryover. There is now no limit on how far you can carry your losses. But that loss is always going to be subject to the 80% cap. And the other thing that they did is that there's no longer a carry back. So you can't carry losses back to get your money. The other thing is with the reduction in the tax rate, both corporate and personal, there is a new rule that basically permits a 20% deduction on business income that's earned through a flow-through. A flow-through for U.S. purposes would include stuff like a partnership, S-corp, or a proprietorship. And the old rules basically says those flow-through entities don't pay any tax. It's the partner and or the shareholder that pays the tax. And that tax rate under the old rules the top rate was 39.6%. Under the new rules, for those business income that's earned through a flow-through, there's going to be a 20% reduction because basically they give the corporations a big break. So they have to give something to people who operate a business not in a corporate format, but through a partnership or an S-corp. So that's why they did it. So basically, when you look at it, the top rate basically for a person that operates a business through a partnership went from 39.6% to 29.6% because of this 20% reduction. But they made sure that attorneys, CPAs, and doctors can use this because they define those businesses as a non-qualified business, meaning that we think that you already make too much money and you don't need the 20% deduction. So for those professions, there is no 20% deduction. So people obviously were angry about this. And I know a few law firms that try to segregate their business because every law firm would have a billing function. So they say, okay, fine, then why don't we spin off our billing function, because that's not a professional services function, then the income from that segment should be entitled to the 20% because it's not a professional service, it's a billing service for a professional service. But the IRS has come out and say, no, 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 we don't like that. We need to look at the entire business. You can't segregate, a subset of your function from a business and call that a separate business. So the IRS has been very clear that that wouldn't work. Other notable provisions, like I said, the top individual tax rate went from 39.6% to 37%. And the other thing that the tax reform did is they increased the amount of threshold that you need to file a tax return. So there was a comment from Trump that says because of all these simplified rules, that firms like H&R Block will go out of business because everybody can just file their own US tax returns because the rules are so simple. We'll see about that. Okay. The other thing is they doubled the gift tax floor, meaning that it went from 5 million indexed for CPI to 10 million. So for 2018, unless somebody dies with 11.2 million of assets, there's not going to be a US gift tax issue. So for Canadians who own properties in the US, be it US corporate shares like Apple or a property in the US, the treaty also gives you the unified credit. So long story short, if a Canadian person owns US property, there's not going to be a US gift tax issue unless the worldwide asset of that person is over that threshold. The other thing that was quite confrontational in the Tax Act was that they capped the state income and property tax deduction at $10,000, whereas prior to this act, there was no limit. So they capped the deduction for federal tax for state income and property tax at $10,000. And for the high tax states like New York and California and New Jersey, people were up in arms, right? Because you end up paying a lot more federal tax, but you don't pay any less state tax, right? So New York and California specifically were very clever. They started to set up charitable foundations, and they tell their taxpayer, you can, instead of making a tax payment, you can make a donation to our foundation. And because there's no limit on the donation, you sort of circumvent these set of rules. So there was a big fight between the US Treasury and all the state revenue authorities, and there's lawsuits being filed, but that's what the states are trying to do, is that they have set up foundations in the hopes that this will get around that rule. The other thing that changed was in the US, you can deduct your interest on your home mortgage. They now reduce the principal amount from $1 million to $750,000, so there's a bit of a leakage there. And the other thing is, starting from next year, any alimony payment is not going to be an income item to the recipient, and it's not deductible against income. So if people want to split up, there's a joke that you should do it now. The other thing too is just keep in mind a lot of these rules are transitory, meaning that they sunset in 8 years from now, basically. However, there is a US tax reform 2.0 right now that's being floated around that potentially would make a lot of these provisions permanent. But right now, a lot of those rules are transitory. So one question I always had is, hey, so they give you this 21% grade rate, and they give you this capital cost allowance of 100%. Doesn't the US Treasury lose a lot of money by doing that? Because you used to collect 35, now you collect 21. And businesses can write off a lot more capital costs than they used to. So one way that they sort of made the rules work to pay for all those costs is this provision. Imagine a company like Apple, which probably has a sub in every country on the globe, right? Each of those subs make money. But Apple obviously don't want the money to come back to the US, because once you do that, Apple is going to be subject to US tax on that income. So all this money that's made, in China, wherever, they're all kept offshore, right? There's like news articles that says Apple has billions and billions of cash outside of the US, and they purposely don't want to bring it back. Same thing probably with Microsoft, right? Google, right? All the big multinationals have subs that made money that they, purposely don't want the money to come back to the US. And the Treasury has been trying for decades to encourage those multinationals to have the money come back. They tried lower rates, they tried to, say, we're gonna, make subpart F tougher and all that. Nothing worked until this. So what this provision does is they're gonna say all the earnings that all those companies made through their CFC. CFC is a foreign corporation that's at least 50% owned by a US corporation or person. So all the CFC's earnings for the last 30 years, basically post 86, we're gonna treat them as if they got paid to the US parent, even if they never did. So think about that tax fiction. Apple has a sub in China that made, I don't know, X billions of dollars. That X billion never came to the US, so you shouldn't be subject to US tax. But the Treasury says, okay, we know you made money. We know that you don't want to have that cash in the US, so we're gonna do this. We're gonna have this deemed repatriation tax that's gonna look at your earnings and profits of every CFC you have for the last 30 years, and we're gonna tax them. So Apple have smart tax people, right? So that's why the measurement date, when you look at it, is not at December 31st, 2017. It's the greater of the EMP as of November the 2nd or December the 31st, because when the work leaked out, Apple and Microsoft and all the big multinationals, obviously through their smart tax people, try to do things that make their earnings and profits smaller. So the IRS went back and said, that's good, but we're gonna make the measurement date the greater of your EMP as of November the 2nd when you knew about it, or as of 12/31/2017. So you can't sort of quote unquote play games with your books in the hopes of minimizing your EMP. But they did, through their lobbying efforts, got a very good tax rate, quote unquote. So remember, the standard US corporate rate was 35. The new rate is 21. The tax on this deemed EMP is only, quote unquote, 15.5% or 8%. Why the two rates? The higher rate basically says, look, if you had your earnings tied up in cash, you could have paid that back to the US, but you choose not to. So we're gonna tax you on the higher rate of 15.5. But if that earnings was tied up in tangible property like long-term assets, buildings, and machinery and whatever else, you really couldn't repatriate that cash. So we understand. So we're gonna tax you at the 8% rate. So that's why there's two rates. And unfortunately, this rule doesn't just catch the big multinationals. This rule also catches US persons who are individuals who own Canadian companies, because they're also CFCs. And they pay a higher rate, actually. Because remember, the corporate rate is 21%. The highest individual rate, even with the reform, is 37%. And we had to deal with some of these, and I can tell you that, the first batch of deadline was on April the 17th of this year, okay, for companies that were caught by this. And the IRS was giving guidance the second week of April. But anyways, that's how things go. But, so the guidance are still evolving, but it was a challenge last year. So this provision, is expected to bring $339 billion to the U.S. Treasury over 10 years. Because for every tax bill that passes, the U.S. rule says that you have to justify and you have to basically be fiscal neutral. So because of the reduction in the tax rates, they had to do this to balance the books. And Apple's share on this tax is $38 billion. But the good thing is that you can pay this over 8 years. So you don't have to pay all this tax all at once. You only pay 8% the first year, and it's a changing percentage, but you can pay it over 8 years. The other thing that's a doozy is this global intangible low taxed income, also known as GILTI. Like I said, I didn't make this up. I'm just the messenger, okay? So GILTI, and yes, there's a joke in the tax circle that every American is guilty, okay? So what is GILTI? Now, the provision I just talked about look at the past earnings, right? Like they seek to tax your E&P for the last 30 years. This is a forward-looking tax provision. They seek to tax the CFC's earning going forward. And the idea behind this is, look, if a foreign country hasn't taxed the CFC quite enough, the US is going to tax it. That's the policy perspective behind this, okay? Basically what this says is that if you have a foreign corporation that has made money and its income is greater than a 10% return on its tangible assets, and it hasn't paid enough foreign taxes, the US shareholder is going to get taxed. Okay? So, but they did give you a 50% deduction, and they allow you to use 80% of your foreign tax credit. So when you do the math, basically what that means is that if that CFC has been subject to tax, corporate tax, in a foreign country of at least 13.125%, there is not going to be another layer of tax at the US shareholder level. So put it another way, if it hasn't paid tax at that rate, guess what? The US shareholder will get taxed. The other really bad thing about this is this catches a lot of the American citizens who have Canadian corps. Because how they calculate the taxable income is basically they allow you to have a 10% return on your tangible assets. So think about a lawyer, right, who doesn't have a lot of tangible assets, maybe a computer or a desk, right? And then all the income in the CFC will likely get caught by this provision going forward, meaning that the US shareholder will get taxed directly on the earnings of the corp. There are some planning options, but none of them are bulletproof. There is a fairly popular 962 election, which means that you can treat yourself not as a person, but as a corporation. So you get yourself to the 21% rate versus the 37% rate. But there's problems with that. There's also ULC conversion ideas, or you can restructure your shareholding. But none of those planning ideas really deal with the problem 100%. So that's why, all the tax commentators, and we have seen this as well, is that there's going to be more US citizens trying to give up their citizenship, especially the ones that have companies in Canada. But you got to be careful there because there is a US exit tax. So if you're a high income earner and or if you have a high net worth, there might be a tax when you try to give up your US status. The last thing wasn't from the tax reform, but it's an important update nonetheless. So we've seen a lot of clients with Canadian companies who own a US LLC. And that's not a good idea to begin with because of treaty issues. And that structure becomes worse under this new rule. So what the IRS did is that LLC normally, when you don't make a corporate election, is that it's going to be treated, when it's wholly owned, it's treated for federal tax purposes as a disregarded entity, meaning that it doesn't pay any tax. The shareholder pays the tax. But for reporting purposes, specifically for Form 5472 purposes, wholly owned LLCs are treated as if they are a corporation, meaning that they have to file this form. So any related party transaction between the Canadian parent and the LLC would have to be filed on a separate form. And so what that means is that you need to do a separate extension and a separate mock US return for the LLC, even though for federal purposes it pays no tax. So it's highly anti-intuitive. For an entity that doesn't pay tax, you have to file a return. How does that work, right? But that's where the rules take you. And there's a $10,000 penalty for every missed 5472. There is a reasonable cause waiver that you can plead with the IRS. And yeah, I mean, we've actually had a lot of dealings with the IRS, New York and Los Angeles offices on this issue. And most of our clients come out okay. So I'm happy to report that. And my comment on my dealings with those offices is that those guys are very tough, but they're very fair. They will look at your case and they will consider your facts versus just say, no, that's a rule and you just have to pay the penalty.